Hi, good evening, everyone. It's Terry Gardner from CJ Lawrence on Monday, November 22nd, with a brief video on this holiday week covering three topics. First off, it's that time of year where we take a look at the American Farm Bureau's annual Thanksgiving dinner cost index. So it's quite timely, particularly all the discussion around inflation. So we'll come back to that in a second. Second thing, we want to take a look at the global supply crunch and see if freight flows are starting to ebb a little bit. And thirdly, I want to answer a couple of questions that I've been asked over the past few weeks, particularly on the back of my last video. So first off, one of our favorites this week, every year, and really for the last 2 decades, we've taken a look at the American Farm Bureau's Thanksgiving Dinner Cost Index, where they measure the cost of the traditional Thanksgiving dinner and compare it to previous years. So, and by the way, that cost has fallen for the last 5 years, and but this year, as you can imagine, it spiked. So your Thanksgiving dinner looks like it's going to cost about 14% more than it did last year. The last time we saw a rise in the Thanksgiving dinner cost was 2015, but we only saw a 1.5% rise over 2014. So this is clearly a very meaningful jump. I guess it's not a big surprise, just given what we hear in the financial press with regard to inflation across all commodity and product groups. But the catalyst for the big jump this year was the bird. That turkey is going to run you 24% more than it did last year. But there's a caveat to that, which I'll come back to in a second. Dinner rolls, 1 dozen dinner rolls are going to run you 15% more than last year. And cranberries are up 11% from last year. So those are a couple of the ticket items that are analyzed in this basket of items of the traditional Thanksgiving dinner. One that I don't quite understand is if dinner rolls are up 15% from last year, it surprises me that a bag of stuffing is down 19%. So isn't it kind of made from the same stuff? Very confusing. Something we'll have to dig a little bit deeper into. But the bottom line is that load up on the stuffing because it's cheap this year. So secondly, with regard to inflation and cost, and actually was intimated at the end of the American Farm Bureau study, the supply chain. So interestingly, the American Farm Bureau came out after they had done their study and said, hey, by the way, the turkey prices that we had in our study have actually fallen quite a bit in the last couple of weeks. So if you have waited to get that turkey, you're probably going to be better off because turkey prices have actually fallen over the last few weeks. And that leads us to a discussion of the global supply chain and inflation and prices, and what's happening around the world with regard to manufacturing, the delivery of products, particularly in advance of the holiday season. And there were a few items that have come out in the last few days that we thought were interesting and may be suggesting, these are just anecdotal points, but may be suggesting that the worst of the supply crunch may be behind us. And there were a few items that we thought were worthy of noting. And the sources for these anecdotes vary from the Wall Street Journal to Bloomberg News to others, but a couple including that Toyota is boosting its production in December to a level that is 21% higher than where they were in December of 2019. So they clearly feel confident that they have the raw materials to boost production this December. That was quite encouraging. Certainly here in the U.S., out on the West Coast, the Port of L.A. announced this weekend, that they had cleared 29% of the containers that were clogging their storage and staging areas. So the grease is starting to be applied to the wheel of the Port of Los Angeles. The CEO of GXO Logistics, which is one of the world's largest contract logistics companies, and a company that we actually like quite a bit here at CJ Lawrence, said in an interview that they thought the worst may be behind them. They were seeing an increase of flow of goods into their facilities, and that goods were moving more rapidly than they had over the past several weeks. And then interestingly, the cost of sending a shipping container from Shanghai to the Port of Los Angeles is down now about 20% just since September. And then, other anecdotals that we're seeing in the data flow include, very strong industrial production and capacity utilization numbers that came out for October just in the past couple of weeks, which exceeded expectations. So, it's likely that the supply chain crunch will continue well into 2022, and in particular in some areas of the economy, worse than others. But we are starting to see some ebbing of the tightness in that market in the last couple of weeks. And then, with regard to a couple of questions that I've been asked, first one being, in my last video, in my conclusion, I stated that we were constructive on the U.S. equity markets, and I got a lot of questions about what does constructive actually mean. And my first response was, hey, I'm glad you asked the question because it means you watched the video. But secondly, to clarify that we're constructive, meaning that we think that stock prices can go higher, but that 2022 may be a tougher year than in terms of return expectations than what we've seen in 2020 and 2021. So the market is going to be fighting this headwind of higher rates and higher inflation, which will keep a lid on valuations, which have risen fairly dramatically over the last several years. Earnings have now kind of caught up in 2021. Earnings growth seems to be peaking, and so it's likely that under those circumstances, the market may narrow a bit in 2022. And that's why we think that there are names that can carry the market higher, but we want to be increasingly selective and really focus on the names that can grow earnings in excess of PE compression. So as multiples come down, you want to own the names where their earnings can grow faster than their multiples compress. And then secondly, I've got a question about an analysis that we've done regularly but haven't talked about more recently, which is the fund flows, ETF and mutual fund flows into bond and equity funds. And why is that important? Because it shows, it is thought, it shows that the retail investor biases towards bonds versus stocks, and is somewhat of a measure of sentiment. Although these numbers have sent cross currents for the past several years, we've seen dramatic outflows of equities and dramatic inflows into bond funds. So in fact, and you think about this year and last year, the stock market has done so well, but we continued to see outflows from equity funds. It really doesn't make sense. And I was asked that question. My response is that I think something has to do with rebalancing, because these mutual funds and some of these ETFs are primarily owned by retail investors. And if you think about the old 60-40 or the 70-30 asset allocation with monthly or quarterly or semi-annual or annual rebalancing, when stock prices rise and that portfolio gets out of whack and is no longer 60-40 but is 70-40, at the end of the quarter, at the end of the year, the manager or automatically a rebalance takes place where stocks are sold and bonds are bought. So it makes some sense that bond funds would see inflows in a period where stock prices are rising. I hope that makes some sense. And then finally, to wrap things up for this week, on behalf of our group here, our family here at CJ Lawrence, we want to wish you and yours a very happy Thanksgiving. As always, feel free to reach out with any questions or comments to tgardner@cjlawrence.com or give me a ring here at 212-888-6403. Thanks.